Hey Ken, are you back?
I'm back, and I lost the recording, so we're going to need to kind of backtrack for just a minute or so. Yeah, as I transferred over to you, I completely froze and went into the circle of death, and it
Oh
just
dear.
I totally crashed. So I don't even know if I have
Okay.
the I don't even know if I have the intro, but that's okay. So let me just kind of backtrack for a second, and I can do the intro later, but let's just start from the beginning, just for the purposes of the recording, if we can.
Okay.
And I apologize to you guys, but I want to make sure that the people that did miss this
Hmm.
don't miss this. So let me just go ahead and do that real quickly. So, ladies and gentlemen, the person that we have with us today has been a big hero for me. He has made a ton of money in so many different areas. I mean, he's sort of a new age man, from being a publisher to being a trainer to being a trader who, over the past 20 years, has developed systems that just work through good times and in bad times. I mean, when the market goes up, down, sideways, this man has figured out a way to make it work. And he's been an inspiration to me. We've been partners on a number of different projects. He is truly a master, not just of making money, but also of mastering the inner game. We put together a program called the Flex Your Mind Method, which has inspired so many people over the past few years. And now, as we go back and reintroduce this new trading program today to you, I think you'll be just as inspired as I am. So let me now formally introduce you to my friend, my mentor, and my partner, Mr. David Vallieres. David, you get the virtual
Hey,
clap.
thanks
You
Ken.
get the virtual clap, and I'm thrilled that you're with us today. So, what do we have in store today?
Well, we've got a lot of good information to share, and I want to pack as much value as possible into this hour or so that we have. So, if it's all right with you, I'm just going to dive right in, and I think I kind of know where our audience is, and I just want to make sure that I not only pack in the value, but I also answer any questions that people might have. I think it's important that as they go along, if there is questions, if you could field those questions for me, I appreciate it. Don't worry about interrupting me. I'd like to get questions out of the way as soon as possible because, when people have a question, it's very difficult to wait. I know when I have a question for somebody, I like an answer, fairly quick. So if you do have a question that comes up, and just go ahead and feel free to pass it on to me, okay?
Perfect. I'll be checking the chat box throughout, so just pop in the chat. Let us know
All right.
what you have, and I'll just jump right in.
Okay, great. Let's get started then. First of all, you guys, if you haven't been trading at all, even if you've only traded for just a very very short time, if you're a complete newbie and you really don't know anything about trading at all, I'm sure you'll recognize the screen in front of you. And this is a ETF called the SPY. It's based on the S&P 500. And if we go back, this is like from the beginning of this year for 2013. Here's January 2nd of 2013, down in the lower left-hand corner of your screen. And this was the first trading session of the year. And as you can see from this chart, we've done nothing but go up, really. We've had an absolutely incredible year in the stock market. It has been one of the best years, on record. It's just been a terrific year. Now, we've had bumps along the road. As you can see, we've had a couple of really big bumps here. But for the most part, the market has really just continued to go higher and higher and higher. Now, how could you tell if the market was going to go up or go down? And a lot of people use many different methods to determine whether or not a market is going to go up or down. A lot of those methods include studies and indicators that smooth out price action to determine future trends. Um, they use stochastics, they use MACD or MACD, they use Fibonacci retracement levels. They use Keltner channels or Bollinger Bands. There's all kinds of different indicators out there to help people determine market direction and give them some sense of, is the past indicative of future returns. And for the most part, those indicators, and many have been developed over the last 20 years, generally have hurt trading performance. There's a great guy, his name is Charles Bukowski, who wrote the Encyclopedia of Chart Patterns. I highly recommend it. If you don't have it, it's a great resource. But he wrote an article in Stocks and Commodities magazine just a couple of years ago, stating that the majority of indicators and studies, many of which I just mentioned, have become less effective over the last 10 to 15 years because of the proliferation of these indicators. In other words, there's so many indicators out there that people are no longer focused on price and price action, but they're actually more focused on the indicator to give them some sense of direction, future direction of the market. And what he found was that the study was extensive, going back over 20 years. And he discovered that year by year, the indicator's signals generally became less effective. In fact, they've dropped about 80% in effectiveness over the last 5 years alone because of technology advancements. So because we have larger computing power doesn't necessarily mean we've gotten any wiser when it comes to predicting the market. And it's one of the reasons why I think a lot of people don't succeed in the market. In fact, 90%, 95% really don't succeed. There's only a small percentage of those who do attempt to trade the market on a regular basis succeed. And the reason for that is because they shun the most popular type of wisdom out there. And one part of that wisdom is in using canned indicators. And let me just give you an idea of what I'm talking about. Moving averages have been around forever. They were probably one of the first types of indicators, that you could possibly have applied to a stock chart. But some of the more popular ones are ADX, average true range, Bollinger Bands, which I mentioned, DMI, MACD, which I mentioned as well, on balanced volume, RSI, stochastics, Williams percent R was very popular. There's all kinds of different indicators that you could apply to a stock chart. And let's do MACD here for a second. Typically, you're looking at a MACD chart. You say, okay, well, what does it really do? Well, it measures momentum, yes, and the MACD provides certain signals of when you should buy, especially crossovers and things like that. But what is it really doing? What do any of these indicators really tell you about the market? Well, what they typically tell you is the momentum of the market, whether it's going in one direction or the other, whether that momentum is slowing or changing so that you could tell whether the market was going to go up or down. And it also tells you when the market is about to change direction. Well, at least that was the idea. That was the idea. They were, at some point they were set. They were, it was supposed to help you predict future price action. And unfortunately, as I mentioned, because there are so many studies and everyone is studying basically the same set of indicators, most people have completely forgot about price action itself. And so I've made it, I've dedicated the last, I'd say probably the last 5 years studying nothing but price action. I was in the same boat as most people who are trading the markets, and I was using indicator after indicator. In fact, I even developed my own indicator. And it was, in fact, I sold it, and it was on the Thinkorswim platform for many years, and traders loved it. But the problem is that almost all of the indicators, like I said, is based upon price action, but a lot of people don't study price action alone. they study the indicator instead to give them the signal. And it's almost like saying that, you know, you're not going to actually study traffic patterns. Let's say someone wants to open up a retail store, and instead of actually studying the traffic patterns, they're going to take the averages of all the traffic patterns in that area and then only study the averages, but not look at the actual numbers. And so it didn't make sense to me that smoothing of price action would give me any more advantage in the market than than the indicators would give to me. I mean, it just wouldn't. I needed to go back to the original source of the data. I needed to go back to actual price action to help me determine the future direction of the market, and that's it served me well back in 2008 before the market crashed, before the financial crisis. I started trading back in March of 1987. It seems like almost ancient times now.
You're dating yourself
And
now, you know.
yeah, that's for sure. Yeah, I started trading in March. I even remember the month and the year, March of 1987, because it was a hard year to forget, especially with the crash that came in October of 1987. So I was trading quite heavily back then, but when the market crashed, I wasn't prepared. I had actually gotten out of the market before then because I thought something was coming. I had a feeling that there was a big decline was coming. I couldn't put my finger on it. I didn't have enough experience to really take advantage of that crash in a way that I would have liked to. And so, you know, as my trading career progressed and I was in and out of the market, I had a full-time job. I was actually working. I had the second highest paid job in the city that I was living in at the time, but I was still following the markets and trading. And you know, over the years, the market was constantly on my mind. And you know, after I started my business and started self-publishing, you know, I went to look at my bank statement one day and I realized, hey, I've got a significant sum of money here. I need to do something with it. I don't want it sitting in a bank account earning, you know, 1.5%. And so I started really digging into the market about 5 years ago. Again, of course, I'd always been following it. I'd always been trading, but I said, you know, I really need to find a different way to trade. And I said, the stock market, my central principle of the stock market is that it's a very powerful but natural source, a very powerful force in the world, very much like the weather. So, you know, we can look at weather patterns and you can almost tell, you know, you can tell even if you're not a professional weatherman when a storm is coming. You know, the wind starts blowing hard, you know, maybe it gets dark in the middle of the day. You can tell when a storm is coming. And the weather is a very powerful force in the world. Well, I thought that the stock market was also this very powerful force because there are millions and millions of people trading all over the world in the market, and they are a significant force. And so I started to compare the weather to the stock market. I said we can tell when the weather is going to change, whether it's going to be calm or it's going to be very stormy. And I said, why can't we apply that common sense to the stock market? Well, I started studying, instead of studying the indicators and the smoothing of the price action and moving averages, I started looking directly at price itself to help me make a determination of future price action. And what I found was that it was incredibly accurate. Let me give you an idea of how this actually works. When we take a look at the beginning, down in the left-hand corner of my screen, you'll see that we started trading on January 2nd, and you can see small patterns here, just just a green bar, a red bar here, and let me see if I can zoom in a little bit here better.
Well, that looks
Give you
good.
a better idea. Is that better?
Yeah, looks good.
Let me
Yeah.
see if I can. Let me see if I can
And as
try
we're
to.
making those adjustments in view, let me just pop in two questions that have come in the chat, because
Okay, sure.
Jim's asking if you've been calling for a crash. He says he saw some, he thought you may have been talking about a crash.
Yeah, actually, I have, and we're gonna actually do a little bit of a case study of a recent call that I made um, from September 9th through September 19th through October 9th. We had kind of a mini crash in the market, and about 1,000 points fell off of the Dow. But I have been calling for a crash for a while, not a crash, but actually a decline in trend. Um, and I have been calling that for a while, but I'm telling you, it's very the Federal Reserve is resilient, and as long as they're in the market buying stocks, which they are, which they do on a regular basis, it's going to be really tough for the market to decline. But there's going to be a reckoning coming very, very soon. In fact, if you guys are interested, I can talk a little bit about that as well. But they have only been putting off the inevitable. Eventually, the market is going to decline, I believe, in a very significant way. And rather being afraid of it, I think that it's going to be an incredible money-making opportunity, an investing opportunity. If you guys are interested in discussing that a little bit further, just go ahead and type something into the chat box and let Ken know that you're interested in discussing that.
And Jim says, "Oh yes, he's
But
got."
let's take a look.
Yeah, Jim says,
Okay.
and of course, and Harvey probably does too. Harvey's asking about whether you're still using condors and calendars and multiple layers, which is probably a little bit more advanced than most of the people that are with us today. But we probably want to answer that for Harvey as well.
Yeah, sure. Actually, there's two types of markets. The market that we were in pre 2008 was perfect for the course that I created prior to the current one, the Winning Trade Blueprint. And that course was perfect for the type of market that we were in. But in order to be a really successful trader, you have to know what kind of market you are in. And right now, the Winning Trade Blueprint is the blueprint for the current market environment. And if you're, if you, when things change, yeah, you can do condors and you can do all types of income producing, option income producing plans. But right now, the market has changed, and since it's about September of 2008. I sent out an announcement to everyone who was on my list suggesting that the market has changed and that system using income producing option income system was no longer valid in the current market. So I guess you have to understand what kind of market you're in before you can apply the correct system to it. And the correct system right now is the system that I'm presenting to you tonight. But that's a great question. All right, so let's go back to this very beginning here of the market for the beginning of the year. You can see that we had a great start, and we had a couple of days in which the market, we had a green bar, we had a red bar, another green, and a red. So very, very light downturn in the market here after a great start. And then the market just took off. It just started rising here on the SPY, at least from 145 up to a top of about 153. A terrific move, a really, really great move. Now, wouldn't it have been absolutely fantastic to get into the market when it was down at this 145 level and then sell when it was up into this 153 level? Wouldn't that have been absolutely fantastic? What do you guys think?
I agree. I'm seeing a lot of agrees. Yes.
would is there is there any way that you could have told or foretold that the market was going to rise over this period of time? Well, I think for most people that say there's no way, you can't tell the future, right? There's no way that you can tell when the market is going to rise. You can't know the future. Well, there is one thing that we can know, and I found it to be, especially before 2008, I didn't really put it in too much into consideration. I was aware of this component of the market, but I wasn't fully aware of the implications of it until the financial crisis hit. And then I hit the books and I started studying like crazy, and I went back hundreds of years. I went back to rice future traders in Japan in the 1800s to try to find a similarity in the market phenomena that I was looking at, and I think that I had discovered. And I went back to charts after chart after chart after chart, and it brought me to a point where I said, you know what, the market itself is almost as predictable as the weather. Now, the weather guy on TV, as you probably know, doesn't matter where you live, he's not right 100% of the time. He's right maybe 70, 80, if he's lucky 90%, but he's never right 100% of the time, and you can never be right 100% of the time in the market. But what I think I found was a very valuable key in helping determine future market action, and that key was volatility. Now, when you think about volatility, I think most of you guys, if you've had any trading experience at all, you probably think of the VIX. Well, the volatility index for the S&P 500 is the VIX. And what that does is it basically measures the amount of fear that there is in the market. They take the number of puts that are being purchased on the exchanges, and they take it's a very complicated formula, but the essence of it is when the VIX is low, there's less fear in the market, and when the VIX is high, there's more fear in the market, and people are buying puts, and they're buying protection of all kinds because they're afraid that the market is going to crash. We'll talk about that in just a second because it's actually a really critical component to determining future, past and future market action, but in looking at past market action, but also looking at the future of the market. But more importantly than that was that the VIX had a certain formula. It was a calculation that the exchanges do, the CBOE does, in order to determine the volatility index itself. But there's another aspect of volatility in the market that is even more important in helping predict future price action. So let's take a look at this period again, and then I'm going to go into a case study of a call that I made recently on the market where the Dow dropped about 1,000 points. So we see that we see here that we've got a little bit of back and forth. Now, one of the things when I do a daily trading video analyzing the market using my winning trade blueprint system, and one of the things I do at the end of each session is I tell traders to go out there and trade with confidence. Because as soon as you lose confidence in your ability to trade, you've lost in the market already. You need to have confidence in what you're doing. You need to be able to make decisions with some sort of confidence that the decision you made is going to come out profitable. It's not always going to happen, but you need to have that confidence level. But let me share with you how I knew at this point, right after the first of the year, the market was going to rise. Now, I didn't know how much it was going to rise because I let the market tell me that. All I knew was that the market was going to rise. And the reason I was able to make that determination was because of the volatility within each single price bar, and also volume. Volume plays a big role, but not as big as it used to, but it still plays a very significant role. So just price action alone and volume tied to that price action, I can get a pretty good idea whether the market is going to rise or fall in the near term. So as you can see, the market started rising right after the first of the year. We had a little bit of selling here, but it wasn't anything significant. But then these 3 days here were actually very significant because the market declined, and what it was doing, it was testing the current price level. When it tests the current price level, it comes down, it's coming down into a price level. It's declining at this point. And on this third day, even though it was a loss for the day, the volume was significantly lower than the preceding days before it. It was significantly lower. And what that was telling me was that selling pressure, even though the market was down that day, selling pressure was fairly insignificant. There wasn't a lot of selling pressure coming into the market. Another thing that helped me determine that the market was going to rise at this point was the fact that the range of the bars were fairly mute. In other words, they weren't wide-ranging bars. The range on this bar was 145 approximately to about 145.90, about 90 cents. That's still a fairly significant range on the SPY, but it wasn't so significant that it would negate my analysis at this point. But the lower volume on a slowly declining market gave me a signal that the market was going to rise and a long position would pay off. And that's exactly what happened. Right after this bar was very significant in my analysis because the market gave itself and traders an opportunity to sell, but they didn't take it. And that means that there were only buyers left. No seller stepped up to the plate. And at that point, it was safe to go long. And that's exactly what we did. The market started to rise significantly from this level, about 145.66. It continued to rise steadily without really much of a downturn at all until we got here, but it reversed itself. And then we got up to the 150. We broke the 150 level. And then we had a couple of days in which the market declined. And this could have been a significant decline. But once again, we didn't exceed very much the previous low. And the very next day, we reversed these 2 days completely and went on to a new high. Now the next day was very significant. Now I'm still holding my position. I'm not exiting my position yet here. But the next day was fairly significant. You'll notice something important about this bar. This bar was very significant. Now this bar becomes significant as well. This was significant in a different way because when the market started to decline, it did so with an extended range. This extended range bar gave me an indication, very much like in a weather situation, if we continue with that analogy, that the wind is starting to pick up. You know something's coming, but it's not quite here yet. So maybe you can hear the thunder very, very far off. You can feel the wind starting to blow. Maybe the clouds are starting to form above you. And you can see that at this point, something significant may be happening, but it's not here yet. And that's almost the case in every single scenario that I looked at, going back almost 20 years on charts that I've reviewed. Is that there's always a warning sign before the storm hits. And this was my warning sign. I knew it wasn't time to exit my long position yet, but it was a warning sign. So I was alert to the fact that something else was coming. And so when I looked at this bar, I said, okay, I'm not going to exit my position yet, but I'm going to keep a very close eye on the market. Well, luckily the next day we advanced. In fact, we continued advancing, and we broke the 152 level, and then we got all the way up to 153 and broke the 153 level. Now the next day after that was a significant event. But we also had a foreshadowing prior to that, because this bar right here was also significant. Not in the fact that it was not just the fact that it was a declining day. or that we had reversed the decline during the day and closed above the 50% of that range, but the volume was very significant. So we had a declining day on extremely high volume. So what does that tell you? Well, it tells you that selling is starting to come into the market. Remember, selling was absent here. We had a declining market with low volume. Now we have a declining market with high volume, and that means that selling is starting to come into the market. It's something that you need to pay attention to. Now, the next day, we had a significant rise in the market. We reversed this and continue to go higher. But look at the volume. The volume was almost insignificant. That was a warning sign that I should exit my position, and I did so on that day. The volume told me that there were very few buyers stepping up to the plate to push this market higher into a new territory above the 153 area. They just weren't there. Instead, I recognized from the previous day that, in fact, with the high volume there and a declining day, that sellers were starting to come into the market in a significant way. And so I should alert myself and exit the position. Now, my personal money management strategy would indicate that I would take 50% of my profits off of the table at this point. I would keep the remaining 50% with a very tight stop. And that's what I did, and I exited underneath this previous low here. So the low of this day, I exited the remaining 50% of my position, just in time to avoid quite a bit of volatility that came into the market, driving the market all the way back down to a low of 148 from the 153 level. This bar here was extremely significant in giving me an indication, a future indication of price action. It told me that, number one, that volatility inside the trading range of this day was increasing. And like I said, it foreshadowed what was to come. This particular day foreshadowed this increased volatility that was ahead of it. And for over 20 years of studying these charts, that is exactly the scenario that happens almost every single time that you can possibly think of in the market. There's always something that foreshadows. There's always that pickup of the wind, a little bit of raindrop that you feel on your face. The analogy of the weather is, holds in this case. You know a storm is coming. It's not here yet, but all of a sudden it shows up right here where you least expect it. And that kind of analysis, in fact, what I'll do now is I'll go to a case study of a recent event in which our subscribers profited significantly from. And I could go through chart after chart after chart with the exact same phenomena happens almost all of the time. For example, here was a fairly large and significant decline in the market with high volatility. That was foreshadowed not only here because of this decline, but it was also foreshadowed as the market continued to rise. And then we had, of course, this bar, which was the biggest signal of all on extremely high volume, a complete reversal of the advance that had taken place before it. Should have been your signal that, in fact, a significant decline was coming. Let's go to the scenario that I mentioned in the case study. Recently, I made a call to my subscribers, letting them know that in fact this was going to be a significant top in the market over the near term. This happened approximately on September 19th. We had a new high in the S&P 500 in the SPY here. We also had a new high in the Dow Industrial Average. The market had declined, but it had reached up up to a new high. And if we take a look at this with a trend line, you can see that it broke the old high right about here. Oops, that didn't stick. And we went up to the new high, and then we had a significant decline, approximately 1,000 points on the Dow, from the SPY 173 down to approximately the 164 level. So fairly significant decline here, well predicted ahead of time by the amount of volatility that was in the market, even as it was advancing. And this is one of the scenarios that I presented to subscribers, was that, and for those who had purchased the Winning Trade Blueprint, that when you have, even in an advancing market, when you have wide-ranging bars, even if they're green, even if they are up days on those markets, that indicates an internal volatility that is foreshadowing a future event, and especially a future event that will probably result in a significantly declining market. So even though the market goes higher, it doesn't necessarily mean that there isn't something wrong with the market. In fact, on this particular day, we had a significant up day after the market had already been up significantly over the past couple of weeks, indicating that, in fact, there was a climax in buying pressure here. High volume, a wide-ranging green bar, but that wasn't the only signal I got. There was volatility in this day because it was extremely wide-ranging day. And what I mean by a wide-ranging day is that if you take a look at this bar and compare it to many of the bars previous to it, you can see how much larger in range it is. It's called a wide-ranging bar, and it's a significant indication of price action. And many times it foretells what's going to happen in the future as well. Now, on this particular day, the scenario was that I alerted subscribers to the fact that we probably have reached a top and that a significant decline is coming. At the 173.46 level, it was recommended that short positions be applied to the market. Now, there was one thing that sealed this particular deal. I mean, it would just really, it was the icing on the cake. I knew that the market was already extremely volatile, even as it advanced, and that a significant decline was coming. But here we are with a new high. And when I took a look at the VIX, now the VIX is supposed to measure the fear in the market, right? Well, this is the same time period here. We had at that time gone from a high in September 9th. Let me just see if I can find it. It's right in here. A high of here all the way to a low on September 20th, which was that long-ranging green bar that I showed you. Or it's very, very close to that. I think it was this bar right here. At the same time, all of the markets, especially the SPY and the Dow, were making a new high. Look what happened to the VIX. It was not making a new low. Typically, the VIX which would indicate, is very, very closely tied, of course, to the S&P 500. But when the market makes a new high, the VIX should be making a new low. I expected that the VIX should have been down at this level at the very least, the 11 handle or lower, on that day in which the SPY made a new high. But it didn't. In fact, it made a higher low. That divergence between the VIX and the SPY making a new high is one of the most reliable indicators possible to determine future price action. And I knew at that point the decline was coming. The decline came. We lost about 1,000 points on the Dow, And in fact, I alerted subscribers at this point where the market had reversed based on intraday action that they should exit their short position. And then the market, of course, advanced from that point, and this is where we are right now. I also alerted, in fact, subscribers to a short position, short potential rate in this area, 175.89. We had a very short-term play here, and we had a nice profit nonetheless on this decline over 2 days. But I also alerted subscribers to exit that short position during this day here while the market was still in the 174 area, based on very much the same analysis. The VIX, once again, not making a new low. Instead, still staying above this previous low, another divergence. So the market itself will predict what the market is going to do. And price action is probably one of the best indicators you can use to determine future price action. When bars start to get really wild, when things start to get wild, that means a storm is coming in the market. And most likely, in almost every single case, when volatility increases, eventually the market will decline. And it will give you clues to what's happening or what will happen in the future. I hope that was helpful for you guys. If anybody has some questions, I'd be happy to answer them. And we can also talk a little bit about what I see with markets and the Fed and that kind of stuff.
Cool. Yeah, Jim's asking. Yeah, Jim's asking, isn't it true that probably due to the Fed that there haven't been many wide range bars at all lately, or just steady up?
Well, actually, there have been quite a few wide-ranging bars. If it's better, it's almost easier to make that determination on the Dow rather than the SPY. So if we go over to the Dow Cash Index, for example, you can see that these wide-ranging bars were really significant, especially towards the bottom of this decline that I just described to you. Look at this wide-ranging bar. We're up 384 points that day. We've continued to have really wide-ranging bars on the Dow especially. Even most recently, we've had a couple of very wide-ranging bars. I would consider, I mean, if you go back even further on the Dow, you can see how small, relatively small, these bars are compared to the ones that we're seeing right now. And that gives me an indication that we are very, very close to a significant top. And I wouldn't be surprised to see the market decline significantly from here. The only caveat would be if the Fed continues to step in and buy on every single dip, which it seems like they have. Somebody did a study recently showing the effect of QE, quantitative easing by the Fed, being removed from the market or not being applied to the market as it has over the last few years, where the market would be today if that was the case. And you know, the market right now at 15,509 would probably be closer to 10,000 or 9,000 without it. The Federal Reserve does go in, and if they've publicly stated that they do go in and buy stocks. So, you know, I think what they do is they just come in, they're hoping the economy is going to turn around on its own. They're hoping that the buoyancy of the stock market is going to improve the economy, improve confidence, consumer confidence. And the fact that it hasn't really done that, I think has got to be of concern to the board. That's for sure.
Yeah, there are a couple more questions here. Jim wants to know if you believe that only a 3-stock Dow index can give the best or even good readings.
Yeah, actually, I do think so. The Dow because it's only 30 stocks, is more sensitive, I think, to price action than the SPY, which is the S&P 500 ETF or some of the larger indexes. I think it's more sensitive. So many times you get an indication from the price action in the Dow before you will in the S&P 500. And it's significant because the Dow Industrial Average, even though it's comprised of 30 stocks, it's the 30 largest capitalized stocks and globally significant stocks in the world. So you have, well, maybe not in the world, but at least in the U.S., and they are extremely sensitive to price action because there's only 30 of them. But they are global in nature, and many of them will feel they're very sensitive to interest rate changes. They're very sensitive to debt levels, credit ratings, consumer confidence. So many times you can pick up, future price action indications from price alone in the Dow Industrial Average before you ever see it in the S&P 500.
Cool. And then Anthony wants to know, aren't the high dividend paying stocks the best way to buy and hold?
There's absolutely a terrific strategy that I use quite frequently with high-paying dividend stocks. As long as times are good, they're going to continue to pay those dividends, right? A lot of stocks will resist cutting their dividends even when times are bad, but things get really, really bad. They're definitely going to have to cut their dividend. But yeah, I think it's a great idea. I love dividend paying stocks. Now I play it a little bit different maybe than you would. Maybe you're talking about a long-term buy and hold strategy with dividends. I'll just share with you one that I like, and just a disclaimer: I invest significantly in this stock. It pays a fantastic dividend. It pays a 9.5 cent per month dividend, and per share. And I've purchased it as low as $6 a share, going back a very, very long time during the market crash back in 2008, 2009. Let's see if I can get back that far. I don't think I can. Yeah, let me go back a little bit farther here. But it is, it's not a stock. It's actually a, down at the 6 handle here, was an absolutely incredible buy at 9.5 cent dividend per month. It is
per month.
A terrific hold per month. 9.5 cents per share per month. It's an incredible buy. It's a convertible opportunity fund. So they're purchasing convertible bonds, and they've got a mixed portfolio of high yield. Some would consider junk, but that's a small percentage of their fund. But it's a terrific strategy. I mean, if you're looking for safety, now during the market crash from 2007, 2008, 2009, it was down significantly. So you're going to lose capital here. You're going to continue to get that dividend, but at the same time, would you like to sit through a this kind of a decline from the 20 level all the way down to 6 with a significant number of shares? Sure, that's a great idea. So I like to time my purchases of CHI along with the stock market itself and my analysis of the market. But I love dividend-paying stocks, definitely.
Yeah, I like the way that thing's paying out. Terry asks a really good question, Dave, and that is, what are the results of the winning trade blueprint this year? Winning percentages, risk rewards, and so on.
We don't publish those because it's. I mean, I think if you were in the membership site and you took a look at the track record, like for example, one of the calls that we made was on GLD, significant trade that we had this year, and it came off beautifully. I'm not going to give you any numbers because I don't want to misstate anything whatsoever. But we were short GLD from this level at around 150, and we got out around 117. And one of the reasons was, number one, we were already in a fairly significant decline in gold, and we knew that the shelf was important. We declined through the shelf. Actually, I'm sorry. See, that's why I don't want to do it from memory. I think we were up at this level, and we ended up getting out at this level here down at 131. My memory is horrible, but you're talking about February and January here. Come on, I'm 55 years old. My memory's not as good as it used to be. But we were significantly short gold and silver during this time period because it was a perfect setup. The analysis was that it was sitting on the shelf. We were in a declining wedge. It's very basic technical analysis. You didn't really need to be a genius to figure this out. This was a great trade. We had two significant wedges here, and almost always the price will break down below the horizontal line. It almost always breaks down below that horizontal line if you're in a wedge pattern, declining wedge pattern. And so it was really a no-brainer. No real special skills on my part were needed to call that one. But we've had significant returns with the winning trade system this year. I just can't give you any specific numbers. I don't want to misquote anything.
So yeah, and I mean the cool thing is that your results are going to be different anyway. So Dave could have done an 87% return. You could do an 88. You could do a 52. You know, so the bottom line though is that it's going positive. Dave, you're making money, right?
Yeah, that is absolutely true. Your personal trading and investment style may not match ours exactly. You may not get in exactly at the same point we will. If you're not available to watch the market during the day, which usually is the best time to make a entrance into the market if you are either going long or short, all those factors, your risk tolerance, there's lots of factors in trading besides technical analysis that you need to consider, and your tolerance for risk is certainly a big one.
Yeah, and Bill is asking we've been talking about the winning trade blueprint, obliquely over the past hour or so. What exactly are people going to learn in the winning trade blueprint?
Well, they're going to learn in a lot more detail what I've already covered in this short session that we've had together, and that is how to read the mind of the market. It's really how to look at price action in a completely different way. So if you're looking at, and the analogy is just so perfect between the weather and the stock market. The weather is a gigantic, uncontrollable force in nature. And the stock market is a very large, uncontrollable force in the world based on the interaction and decisions made by millions of human beings. It can be, I would say, to a very small extent, small extent manipulated from time to time. And what I say by manipulated is that large traders can step in to support stocks, including, significant government entities stepping in to support stocks. And I think they have done that over the past several years. But we will go over in detail all of the things that I've just discussed with you, including how to read individual price bars, how to factor in the VIX when determining price action, how to use basic technical analysis to determine future price action, as well as entry and exit targets on your trades, how to actually, what instruments should you be using in order to generate the greatest profits in your trades. So for example, after a significant decline, let's take this decline here. Let's take the decline that we used as a case study. The market dropped about 1,000 points. The volatility index went up significantly. At the bottom of this market, what would you say is the very best strategy if you knew the market was going to advance at this point? Let's zoom in here. If you knew exactly you knew exactly that the market was going to advance at this point higher, how would you take advantage of that? Can I get somebody to give me a kind of a very, very brief answer, because the answer is actually really, really simple.
Okay, guys, jump in.
Would you just step in and buy stocks here? Would you buy options? Would you buy futures? What would you do?
I've got deer in headlights, is what I'm seeing here.
Yeah. Okay. Well, let me give you an idea of what happened back in 1987. Stock market crash, right? That's even more significant event than this. It was 500 points in a single day was unheard of at that time. The volatility index went through the roof, and I knew actually someone who actually my broker relayed this to me. I had an account with Kidder Peabody. I don't know if anybody's old enough to
Oh my
remember
gosh, I
Kidder
remember. I
Peabody.
remember them. I remember them.
Do you really?
Yes, I do.
Well,
I'm older than you are, Dave.
well, I had a broker, an old time broker. His name was Ned, and I remember when I was trading with him, and I was trading some significant option positions at the time, probably way above, way more risk than I should have been taking back in 1987. And he called me one time, and he says, "Do you want?" The market was down about 68 points. I had a significant number of puts on, and he goes, "Do you want to exit the position?" And I go, "Let's give it a couple more minutes." And within a couple of minutes, the market had gone up about 15 or 20 points, and I called him back. I said, "Let's get out." Well, that hesitation on my part, not taking his advice, cost me $15,000.
Oh my.
And yeah, it was a difference of $15,000 profit
Whoa.
on that one position. And later on, I was talking to him, and he goes, I never call a customer, ever, to ask them if they want to exit a position. He goes, I did it for you because I knew that the market was going to turn around and go higher. And he was telling he was a neat broker. He was a pretty cool guy, and he was telling me that during the crash of 1987, a couple of new traders on the floor of the exchange were buying calls like crazy, options, call options specifically. And they were buying them like crazy because they knew the market was going to go up. Everybody knew it. It was just it was a temporary decline in the market that was significant, but it was going to be over. And they lost their shirts. Now you think that when the market goes up, it makes reasonable sense to buy calls at the bottom of a market to profit from the advance, right? The problem was the volatility was so high that they paid through the nose for those call options. And as the market rose, volatility was drained out of the market, and so was the premium in their call options. It might be a little advanced for some people, but the bottom line is they paid a very high price for those call options when, even though the market rose, they failed to profit from it. So the answer to the question, what you should do at the bottom of a market, is not buy call options. That's the bottom line, because volatility is already so high, you're paying a premium for those options. But it's perfect at the top of a market to buy put options. Why? Because volatility is significantly low at the top of a market. So you want to buy put options because there's no premium in them. You can get them dirt cheap. And when the market drops, it usually drops pretty fast and pretty significantly and pretty quickly. And that's exactly what happened with our case here when the market started dropping. And the put options would immediately increase in price in two ways. Number one, it went in the direction that you expected them to go in. The market was declining, and your put options were increasing in value. but also they increased in price because of the increased premium due to volatility in the market. And so it was a double win. But at the bottom of the market, you don't want to buy call options. You want to do something else. And those are the kind of things that I teach you in the course, to how to significantly profit from opportunities using the analysis that I share with you.
Well, yeah, that's going to be really important, is the fundamentals and the why, and the understanding of the why. And in fact, Anthony's asking about
Yeah.
Carl Icahn with buying the why behind why you think he's buying the huge stake he's been buying in Apple.
Yeah. As a, I think it has to do with it does, I heard that on CNBC actually. I think it was this morning or yesterday. Carl Icahn and his son had a bet about Netflix. His son told him he should buy Netflix, and Carl Icahn got out too soon. I guess he sold his shares when Netflix was up, and now he's buying Apple. I think his son is starting to take over a lot of the business. So his son is very forward-looking. I think Apple's one of his favorites. So that's probably why he's buying it.
Well, I like the idea of about understanding where things are going, and I know a lot of you that are here today are new to the marketplace and are looking for an add-on to your current source of income that'll stabilize things, which is really why I think this is so important. So in terms, let's walk people through briefly what they're going to be able to expect when they get the course, and because people have been asking, tell me about the course. It's a video course, and it's you teaching them on video, and,
Right.
and maybe you can give a little bit more detail for everybody, more than I probably can.
Yeah. It's even though. Excuse me. I got to get a drink of water here. Even though it's a new course, and it's in many ways it's more of a beginner's course than my first course. My first course was really quite advanced. This course is not only for this type of market that we're in, but it also takes you step by step through the very basics of the markets, what makes a move, significant things to look for, my style of technical analysis, which is very, very simple. And I think that most people find it to be extremely refreshing because it's not complicated. There's only really a couple of different things in this market that make it move or give you an advantage of determining future price action. I've talked about the wide-ranging bars. I didn't talk about short bars yet. And typically what happens is after a period of volatility, the bars begin to shorten in range. And when that happens, you know that the market will continue to rise. I mean, there was a period in the market recently, just a few years ago, where the market went up every single day, like 10 or 20 points on the Dow Industrial Average. And it went up for weeks on weeks and weeks, and people couldn't understand why. Because there was no volatility in the market. When there's no volatility, the market won't drop. It just will not drop. And you have to be aware of when that change is coming, and then you'll get an idea of when the market will change. So in the course, I take you from the very basics of price action and teach you every single facet of price action that I'm aware of that will help you significantly determine future price action. And like I said, you're not going to be 100%. You're going to be 80%, 70%, 90% at times. But it certainly does give you a heads up, and it's probably one of the most significant ways to determine future price action. Because it's so simple, most people ignore it. It's amazing. You learn how to read price action by looking at price charts. And most people think that's an old-fashioned idea. maybe they think, well, actually it is. It goes back to the 1800s with rice farmers in Japan, trading futures contracts on rice, and they looked at specific details in price action to help them determine the future of rice. And the same thing is applicable today. So I take you through the very basics, through more advanced studies, but more significantly, it talks exactly about how to profit from these changes in the market, how to know what's coming ahead of time before it gets here, and how to profit from it.
So what you're doing is sort of you're putting on X-ray vision for the future, and you have a crystal ball that actually works.
Exactly, just like a storm coming. You can tell when a storm is coming, right? You can
Yeah,
tell the wind is starting to pick up, it gets dark, the clouds come in at, noon, something's coming. Well,
yeah,
and it's not hard to predict that storm. The same thing happens in the market over and over and over again.
yeah. Yeah, that's a great metaphor. I really like that metaphor very well because it's true. You do know. I mean, I walk out the door. I live in Thailand, and I walk out the door, and I know whether I need an umbrella or not.
Mhm.
And when you do know the market, and back a few years ago when the big tsunami came, the humans didn't necessarily know what was going on, but everyone else, all the other creatures, they were running uphill, and that's why all the animals fled because they knew
Right,
their instincts were there. So
right. And they have significantly less brain power than we do.
yeah, yeah,
They knew what to do, and we
yeah.
didn't.
Well, it's funny because you talk about things being simple. I had dinner the other night with a trader, and he was exposed to some of the things that you're teaching, and he said, yeah, the bottom line is the guys that are really making the big money are doing things so simple that it's ridiculous, and all the other add-ons and all the other hoo-ha is is just that. It's noise, but it's the
Yeah,
simple way of trading that's really making the big guys the big money, and they don't want anybody to know it. Because
absolutely.
he said I will not teach this. He said because it's just I don't want anybody to know how simple it really is. So you're codifying it in this, and that's why I'm so proud to be able to publish this together with you. Because I mean I'm not a trader, but I follow what you're doing, and you inspire me because you do make it easy. Jim's asking if you're shorting the market right now.
No, not yet. We did during this downturn, this 1,000 point drop. We got out of our short position when we realized that we'd probably find support right in here, right at this previous bottom. The price action here also gave us an indication that it wasn't going to continue any further. So we got out of our short position. We're not short the market yet. There was a possibility that this could have been a significant top here, but it was not. Let me go back to the SPY for a second and show you what we were looking at. Um, there was a potential for a short position that could still turn out very, very well in the current market. If we take a line across this top here, talk about simplicity. We knew that when this upper trend line was broken to the upside, in fact, I had did an analysis on this day and on this day, the previous 2 days before it broke above this trend line, that the market would be up about 100, 150 points. It was a perfect opportunity to short the market. And that's exactly what happened. We got up to 170, approximately 176, not just shy of that. And we shorted the market at that point, but we got out the next day because the volatility of that day was significantly lower than we had expected. And that's all it was measuring the volatility of that day. And we knew that the decline would not continue. And so I alerted subscribers to the fact that, put a very tight stop on your short position and let's get out. Um, and that's exactly what happened. The next day it was up, but we're right at that line right now. So if we stay below, we closed just a hair above it, and of course this isn't going to be 100% accurate, but if we close and continue to stay below this 175.09 level, I think that this, what I call a throwover, this is a throwover above this trend line. At this point, I'm looking for a significant decline to come out of that. What I've been updating, and this is really simple stuff, though. I mean, you've got a basic trend line coming up here on the market. We've got it's almost like a wedge pattern. After you've gone above this trend line, I would expect that we come all the way back down to the lower end. So we're looking at a fairly significant decline here, but it's kind of too early to tell. We're right at that level. We'd like to see some increased volatility before we, take another short position. But I think on a longer term basis, I think we are in trouble. I think the stock market in the U.S. is going to be in trouble. My longer term vision for the market is that interest rates will rise over the next 3 to 5 years to, we got very, very close to 3% on the 10-year Treasury note, and that's one of the indicators that we're looking at. When we look at indicators, we look at actual price action of ETFs. The TBX is one of the indicators that we look at. It is the 10-year Treasury note. It's our stand-in for the Treasury note. It's our proxy for the Treasury note. And it's an inverse fund. So in other words, when it rises, interest rates are rising at the same time. And so it's very easy to follow. You just take a look at the trend. Is the trend up or down? If the trend is up, that means interest rates are rising. If the trend is down, interest rates are declining. And we saw a significant rise up from this bottom, approximately 31.57. The 10-year Treasury note at that time was, I don't know, maybe it was 2.3. It got up to this level here, right around 34.60. Got very close to 3% on the 10-year Treasury note. Well, this is a typical rising wedge pattern. We fell below that. We got below that. But I think over the long term, we're kind of getting into some support levels in here. Another typical pattern, which might be a little bit more advanced for some people, is the previous consolidation area. This is a previous consolidation area. It tends to act as support. And so we're looking at support in this area all the way down from about 32.41. And if this holds, and I believe it will, I think we're going to see 10-year Treasury notes rise above eventually 3% in about 34.60 on TBX. But that's one of those longer-term calls. I'm looking for the U.S. dollar, which has been just completely dissed. I mean, the U.S. dollar everybody hates the U.S. dollar. Nobody likes the U.S. dollar. Well, if interest rates start to rise in the U.S., that puts incredible pressure on the Federal Reserve with all of the debt they've been buying, all of the bonds that they've been buying, all the mortgage debt that they've been buying, and interest rates are in a rising interest rate environment, they're going to get crushed on those positions. And that's the one thing that I think that they believe they can keep interest rates low for a very long period of time, and they can on the short-term rates. But the 10-year, that's pure market-driven. And if that starts rising, if the market starts demanding higher interest rates, I'm afraid they're going to be in big trouble. So that's one of the things that I've been talking about in our membership area. Yeah, I don't talk about that specifically in the Winning Trade Blueprint because it's so topical, it's so current, it's so today. And I want you to be good traders before you can learn how to do more, these different kind of trades.
Yeah, the key is getting the fundamentals for sure, and that's why I thought it was really important that we publish the course, make the course available to you, and add in some of the other benefits that go along with it. In fact, why don't we tell everybody what's in it? And I'm going to take the screen. Is there anything else you want to show on your screen, or I'm going to take over the screen and I'll show everybody how they can actually get the course?
Yeah, I'm good.
Okay.
Go ahead and take it over.
Okay, well, let me do that real quickly. And let's see if I can do this, show my screen. Okay, cool. So now let me there we go. Okay, so the Winning Trade Blueprint course is a 16 video course. What you're seeing on the screen here is all the other bonuses and so on that come with it. And if you were to compare trading courses out there and what the value of what you're getting. You know, you're not anywhere near going to be paying the value of what this is. I mean, people will spend $3, 4, $5,000 for a trading course similar to this, but we peg the price at $14.97. But again, that's just pegging a price because you're going to be paying significantly less than what it's really worth. Along with what Dave talked about in terms of what he teaches in the course, let's see if I can go. We're also including another course, which is the Forex Mastery Formula, so that if you want to trade currencies at all, it's a 21 video course, and that's going to be included with you for you as well. Being international, I like the idea about trading currencies, so you're going to have the ability to learn to do that and do that in conjunction with the other trading that you're doing. Is there anything you want to add on that one, Dave?
Actually, the winning trade blueprint works very well with Forex as well. I have been testing it out. I'm primarily a stock option futures kind of guy, but the same principles in the winning trade blueprint are applicable to the Forex market, very much so.
Yeah, and that's why they've been bundled together to make it really work cohesively, which is really terrific. So we're throwing that in to make sure that you have the ability to do both as you want to. We're also including Dave's Inside Days Strategy, which is both a video along with the digital book, and that's a $47 value. You're getting that as well. So you're going to get the Inside Days Strategy. And in a nutshell, Dave, what is the Inside Days Strategy? Not necessarily teaching, but what is it in an overview?
Yeah, that's a very specific strategy that's very short term in nature. So, in other words, a setup would take place. You would look for the setup that I teach you in the video in the book, and within a day and a half, 2 days, maybe 3 days at the most, you're out of the position. So, very, very short term, high percentage of trades work out to be profitable.
And so this could be something that if you're looking for the long term, there's a lot of people that are with us today are looking for a longer term add on to their income. This could be something that you can play with or have your kids play with or have your family play with on a short term basis. Take a piece of your portfolio and just do something different with it in addition to the current position you're doing. Would that make some sense?
Yeah, absolutely. I think it's something that, if you want to make just short-term returns, even though you've got a long-term strategy, if you really want to get to know how market and price action work together, this is a really good strategy. In fact, I call it my bread and butter strategy. If I had absolutely nothing, if I had no knowledge of the market whatsoever, this is the first strategy I would go to and use to make almost daily profits, because you can use it not only on indexes but individual stocks as well. It works great in both.
Well, for the impatient person like me, this appeals to me a lot because yeah, and the other piece of it too is that if you're looking for a fast win, so that you really continue the motivation and so on, it's a great place to start. So I'm glad that we've included that. Then we've got the extreme trading video, and that's another $47 value. And that strategy, Dave, what's extreme trading?
Well, that's when you take a look at the market. This is a volatility capture trading strategy. So in other words, when we saw those wide-ranging bars and we saw extremes of price action at one edge of the market or the other, you're taking advantage of that in a very specific way. It is a higher risk strategy, but it's also extremely high reward.
Cool. So you're going to get the ability to go both ways on that, and then we're throwing in, this is one of my favorites, your $47,000 in a day report.
Yeah.
In some of our promotion, we talked about how Dave made over $47,000 in one day, and you did. And
Yeah, I
we
did
talked,
with real money.
yeah, well, real money. So Dave reveals all of that in this report. We've had a lot of demand for that, so we got him to put it together for us, and now it is completely memorialized. It is included with this. We didn't really have time to go into how we did it today in today's presentation, but you will get that with the course. And
And
you've
I'll
had,
tell you one thing about that report, Kent,
yeah,
is that in it I detail a specific strategy. It doesn't happen very often, but it does happen enough times each year to make significant money. So, for example, of course, I made $47,000 in that one day, but in in one year you could probably do that 2 to 3 times. And if you're in it, and it only happens in a single day. So if you really have low risk tolerance, if you don't like risk, you're going to love this report because it's so specific and the setup is so exact that you're almost guaranteed to have a winning trade. I'm not going to say you're going to guaranteed to have a profit, but you're guaranteed to have a winning trade when the setup is, if you follow the setup perfectly. So, but it only happens, it happens very infrequently. So if you don't like trading a lot, or like the Inside Days videos, maybe you want to do something a little bit different in the market. If you want to have short-term profits that really boost your return on an annual basis, it's a phenomenon that happens, like I said, only 2 or 3 times, sometimes more a year. During the 2008 period in early 2009, it was happening almost daily.
Wow.
For a while. It was incredible. The profits to be made on those days were just unheard of. The market has to be extremely volatile for it to work, but when it works, it's like it's like a lottery ticket. It really is.
Wow. And you know, with what we're thinking about for the future, with where the market's going, my gut is we're going to be seeing a lot more opportunity here than we've seen over the past few years. So this could be something that could be very, very, very lucrative. Yeah, I think we're going to see a lot more madness out in the marketplace just from the things I've been seeing here. So yeah, this is going to be fundamentally important for you guys. So let's put it all together, because here's what you're going to be able to get today with this ridiculously special offer that we put together, and truly we made this ridiculous. Winning Trade Blueprint at $14.97 is where we're starting. Off. You're going to get the Forex Mastery Formula course at $4.97. You'll get also the Inside Day Strategy. You'll get Extreme Trading, and you'll get the $47,000 in a day report. All of that together comes out to a total value of $2,135. No way, no how are we ever going to bring you to that level. As much as we would love to charge that, that's not how we roll here at boostyourpractice.com. We're going to let you get started today for a really, really crazy price, but that's what we decided to do, $97 right now. And there'll be 2 other payments of $97 for a total of 3 payments, but you can start right now for as little as $97. And where you do that is at bypnow.com/winning trade. That's bypnow.com/winning trade. And if you want to save some money, you can actually do 1 payment, and there's an option there on the page. As with everything that we do, you're going to be thrilled or you're not going to pay for it. So it's 100% guaranteed. You don't need to decide, is this the perfect thing? Get it now. Play with it for a month. Test it out. See if this works for you. See if this makes sense to you. See if you agree with me that this is going to be one of the best ways to emulate, to build your portfolio for the long term, and see if this resonates for you. I think it will. It certainly does for me and so many people that have worked with us before on Dave's other course, which we still have available, by the way, and with Dave's mindset courses. I understand that the bottom line behind all of it is who you are inside. So this course will really help you. Grow there. And for the way we've priced this, we just made this a complete and total no-brainer. If you go to the page at bypnow.com/winning trade, you'll see this page right here. And on it would just summarize everything that we've talked about. And you'll see 2 options. You can start now at the $97 price point, or if you want to save $44, you can go right ahead and just do 1 single payment of $247. All up to you. We've given you the option depending upon what your current cash position is, because we really want everyone involved right now. Knowing what's coming up in the future, knowing that a lot of people are still struggling right now, no matter where you are in your business, your personal life, your practice, whatever. Knowing all that, we really wanted to eliminate every single possibility that you would have a challenge getting involved. So either way, $97 or $247, it's entirely up to you. But if you go right ahead right now to bypnow.com/winning trade, you can get to that page, secure it right now, instantly download it right now. You have it available 24/7. And before we started today, I asked David, when people have the course, no doubt there are going to be some questions. People have been asking for that. So, is there a way that people can actually get some questions answered, Dave?
Yeah, absolutely. I provided you with a special email address that I only use for subscribers and people who purchase the course. And so if you do purchase the course tonight, then Ken will give you that special email address. You email me, and I will answer whatever question that you have. And I don't hold anything back. I answer the question in as much detail and honestly, of course, as the questions come in now. My only the only thing that I would ask you to do is please limit your questions to one per month. And the reason for that is because I have so many subscribers and so many customers who are purchasing the course with questions that because of my busy schedule, trading full time, doing all of the other things that I do, self-publishing, and so forth, I can only answer one question per customer per month. So if you could limit it to that, if you study the course and you run up against a real issue that you need answered, um, please save it in an email, send it to me at a special email address that Ken will give you, and I will answer it.
Yeah, that's really a huge benefit, you guys. And we decided to do this, and I really appreciate your willingness to do that, Dave, because generally when we produce courses, the support level of it is a completely different ball game. You guys will also, you've heard about Dave's membership area. We'll give you an access to that and give you an option on a trial basis of that as well, with an extra special bonus. So there's so much here for you, and we've given you the option to get it for just a crazy, crazy, crazy starting point. And it's just, we're so happy to be able to do that for you. So if you go right now to bypnow.com/winning trade, $97 today, get right into the members area and start putting it into action. Start taking that initiative for yourself, for your family, for your business. This is huge. This is absolutely huge. And if you really want to try some different things and even diversify with it even within your family, whatever, you can set up family contests and have people using the same information and seeing how they trade differently within your own family, even within your own business. So you can use this in so many different ways to build and secure your future. But I wanted you to have this right now so that you can get started, because the market's turning. I feel that weather changing dramatically. And again, I'm seeing it from a different side of the world. The level of confidence in the United States markets has changed so much. And over the recent times, with confidence in the U.S. government being able to actually function and get the job done, people were concerned here about what was happening over the past few months. And they're concerned about the future. So being in the marketplace, knowing how to read the marketplace, will protect you from those uncertainties that most people don't understand and will be in trouble for. Knowing that, I love that metaphor about weather, Dave. Knowing how to predict the weather and being able to sense it is going to be a huge advantage, particularly now. So, are there any other questions anybody has, or anything else you want to add, Dave?
Well, you're absolutely right about that, about the storms coming. I'm sure many of people listening right now know that there's going to be a new Fed chief very, very soon, Janet Yellen, and she has her own views of the market, uh, and I'm pretty sure that that's going to bring a what we do from these changes. And I talk talk a great deal about only the U.S. but around the world. Uh, and things are relatively
Well,
calm. It's gonna be too late.
I know I lost you for a little bit, Dave. We were talking about Janet Yellen and what you saw coming in the market. Are you still there? Did I lose you?
Yeah, absolutely. I think
Sorry.
she's going to bring a lot of changes. Yes. Can you hear me?
Yeah, I hear you now. Yeah, we went into static for a little bit there. Are you still there, Dave? I love technology. You were doing great, and then I just lost you. Yeah, the audio did get bad. Yeah, Robert's saying audio got bad. Dave, if you're still there, pop in. We might have lost you, um, so feel free to interrupt me as you get back. Yeah, the technology today has not been so fabulous. Um, Bottom line, at the end of the day, is the action you need to take is right now. Just like we lost David. I mean, just right now with technology, unless you're prepared, unless you've got a backup plan, unless you know how to handle those situations, you're going to be silent just like he is right now. So go right ahead, grab the winning trade blueprint at bypnow.com/winning trade. Get your spot. You'll have access to Dave, via email, of course, and we're happy to support you as well. But do it right now while this is fresh in your mind. And Robert says, "Nice cover." Well, that's exactly the point. It's because I've done this before. This is not my first rodeo, right? Having this program allows you to operate the exact same way. The average basic trader that's going to get involved right now in trading is not going to have the same benefit of working with a 20 plus year successful trader who's been in and out, who
I
understands the market.
think
But yeah, and Dave's trying to come back in right now. But that comes from being
there's
flexibility.
there's
But yeah, he's fluctuating.
uh,
I know. You're there.
for,
You there, Dave? Oh
uh,
no. Oh no. I hear you a little bit, and then you're kind of flowing in and flowing out. Well, guys, are any last minute questions for Dave? Because obviously we're having some big issues up in upstate New York right now. I think. Anybody else? Okay.
maybe there's a storm coming.
I get, well, we know there's a store coming. The question is what day it's coming. I don't know if we'll be able to get you here while we can, but Anthony was asking something about Google stock and why it's so expensive.
Well, Google refused to split their stock. So, for example, over the years, they've just let it ride higher and higher. Typically, when a stock gets to the point where it's, at a certain point, it's 100 or 200 or 300 or 400, eventually they split the stock so to make it more affordable. But Google hasn't done that, so that's why it's expensive, really.
Cool.
It
Cool.
just it just hasn't been split. Most stocks, like, you can take a stock like even GE, if you held it since 1931 or whenever it got into the stock exchange. I know it's one of the oldest Dow stocks, or one of the oldest stocks in the, being traded in the country. Um, if it didn't split, uh, who knows where it would be? Maybe 1,000 or 2,000.
That'd be crazy. Yeah.
Yeah.
Cool.
So they didn't really split their stock. That's why it's kind of expensive. They just they wanted it to be more elitist, I think. I think Google
Yeah.
just wanted it to be elitist.
Yeah. That makes perfect sense. Well, Dave, I really, really appreciate your jumping in today and sharing this information. This has been huge. It's been great for me, it's been great for everybody. I'm seeing that the comments that are coming through are great job. Thanks. Can't wait to get the program. I see a bunch of I'm ins. This is great. Everyone's been trained. When we get
Great.
something, we say I'm in. So this is terrific.
Congratulations. That's
Yeah,
perfect.
you will love this, guys. You will absolutely love this. So grab your spot right now. Join the wow. A lot of people are just coming through here. This is great. So yeah, congratulations to Tim and to Mary and to Louise, Ellen, Jim, Simon. Yeah, I see so many people that are just popping and saying yes, 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 yes. So this is terrific. So let everybody go. It's been a tremendous session today. Thank you again. We will have a replay available to all of you. And grab it right now. We're not telling you that this is a today only offer, but I will tell you that if you don't start today, when will you start? Bottom line is this: the longer you wait, the more at risk you are. Weather's going to change, and are you prepared for it? Do you have your raincoat? Do you have your umbrella? Do you understand how to operate with that? The sooner you have this program and start going through the 16 videos and the reports and so on, the sooner you'll be better equipped to handle the changes that are coming, and they are coming. So we want to make sure that this is like your virtual economic insurance policy. So get that policy now before you get flooded out. So Dave, again,
Yeah,
thank.
protect your family.
Yeah, that's what
Protect
this
your
is.
family now before it's too late.
That's what this is for. That's what this is totally for. So, you can wait. You can wait, but then where are you? Then you've missed tons of opportunity. Don't wait that 15 seconds like Dave waited and lost $15,000. Make the decision now. Go in, give it a shot. Give it a shot. If you're not thrilled, tell us. We'll give your money back. But for what we're offering it for right now, and as we've been going through this, Dave, I got to tell you, I think that we really need to double or triple the price just because people will perceive the value more than they are. I think we've diminished it with going so low on this. So before we make our change and edit this video and change it, go right now, grab it at bypnow.com/winning trade. David Vallieres, you rock. Thank you so much. Again, great to catch up. And I'm very grateful for you being part of this. And thanks for letting us publish you.
Yeah, no problem, Ken. Thank you very much for having me. It was an honor and a privilege to speak to everybody tonight. And thank you again for holding a great webinar.
Thanks. Everybody, you take care. We'll see you at Winning Trade Blueprint. Take care, everybody.
Bye bye.
Bye.